Hello everyone, I hope so you will be fine. So today we are going to talk about study unit 7. So we'll start study unit 7 and the unit 7 is working capital management. So please remember we are discussing actually corporate finance section and it is your 20% of your exam. And in corporate finance section, we have these units, unit number 4, 5, 6, 7 and 8. So 4, 5, and 6 we have already covered. 8 we have already covered. Now we are starting with the 7, which is working capital management. So here we go in working capital management. So we have these topics. First, we will understand today what is working capital and what are working capital funding or financing policies. Then we'll talk about cash management. Today, this is what we will discuss. And then we have other topics in unit number 7, which is marketable securities management, receivable management, and inventory management. So here we go, starting with what is working capital. So guys, by definition, how we can define the working capital? So actually, the working capital is the money a company uses in its daily operations. Okay, like your daily operations are what? Maybe you need to buy the inventory, right? Maybe you need to pay your bills. Okay, so whatever money we use in our daily operations. Okay, and we also definitely we will also meet short-term financial obligations, right? So we need funds for that. So and technically when we calculate the working capital, so we always calculate the working capital as a difference between current assets and current liabilities. So this term is called what? Net working capital or working capital. So generally, if I'll tell you in simple words, like when we start any business, so definitely, for example, if you want to uh, erect a new factory, so definitely you need to buy maybe land, building, plant and machinery. So you will invest money into these non-current assets. So any amount which we invest into our non-current assets, so that is called your fixed capital. Okay. But apart from land, building, and plant and machinery, we also need funds for our day-to-day operations. Maybe you need to buy inventory, right? Maybe you need to pay your other short-term obligations, or maybe you need to pay your bills. So for that, whatever money we will use, that is called what? Working capital. Why it is called working capital? Generally, for example, I'm just giving you one example from inventory point of view, because let's assume today if you will buy the inventory, so you will pay the cash, and definitely this if it is a raw material, so you will process, you will convert into finished goods, you will then sell them to the customers, right? And you will get a cash. And again, once you will get the cash from the customer, again this process will be repeated. That's why it's called what? Working capital. So by definition, when we explain what is working capital, we say generally the investment in current assets, right? So, like whatever amount you invest in the current asset, that is your working capital. But when we say what is your net working capital, like the final amount of working capital, so then you take what? Current assets minus current liabilities. So please don't mix it. So generally we say working capital is the investment in current assets. But when we calculate net working capital, so then we take what? Current assets minus current liabilities. Because in some time in certain books it's written working capital is equal to current assets minus current liabilities. So but as I told you, so first the investment which we will make in the current assets, that is your working capital. But if when you calculate net working capital, then it should be the difference of current assets minus current liabilities. And now the question is, what is included in the current assets? So it may include inventory, right? So we invest into inventory. It it may include receivables like trade receivables. right? So that is also your investment because you spend some money on the products and then those products you sell on the credit. So definitely, so your investment is there also, right? So then you may have some other assets like cash itself, maybe some other things like prepayments, etc. So but here in working capital management, under current assets, we will learn how to manage inventory, receivables, and cash, because generally these are the main items of the current assets. Then the current liabilities, these are those liabilities which generally as a business we settle within one accounting period or operating cycle, whichever is longer. So like these liabilities are short term liabilities, right? And it may include what, like trade payables. I hope so you have idea about trade payables. Means say these are those payables which will arise due to the credit purchases. It may include short-term loans, overdraft kind of things. Okay, so this is what is your net working capital. Now here you have to understand here what are the key points to explain while we discuss this formula. When we say working capital equals current assets minus current liabilities, right? For example, if your current assets are of $100 and your current liabilities are of $40, so it means your net working capital is $60. So now how we can interpret, so we can say this way: if we will use our current assets to pay our current liabilities, because current assets we have for $100 and current liabilities we have for $40, right? So if we'll use our current assets to pay our current liabilities, so whatever the net amount which is left with the company, okay, that is your net working capital. Now, and this is very true, because generally we settle our current liabilities by using our current assets. It's like a similar example. For example, if you want to pay the school fee of your siblings or of your kids, so definitely you will use your current assets to pay those kind of things. For example, what could be the current assets? It could be your routine income like salary, etc., right? So those things you can use, but you will never sell maybe your house or your land to pay the kids fee. Okay, so this is what I'm giving you example here. So what are the key points? So if you will look into this definition here, so we got current assets minus current liabilities, 100 minus 40, so we got net working capital of 60. So this is the positive figure. Now you know what positive figures, what this positive figure indicates. Actually it indicates that the company has more short term assets, like your assets are greater than your liabilities, right? And it suggests that so these assets can easily cover its obligation, right? So this is what does mean by positive working capital. But in case, for example, if you have as current assets of $100, but you got a current liabilities of $120, then you will get an answer of 20 negative, right? So this negative working capital indicates that your current assets are lower than current liabilities, or your current liabilities exceed current assets, right? So this is like actually whenever you are into this position where your assets are less and current liabilities are more, it means you may have some liquidity issues. I hope so you understand that maybe you would not be able to settle your current liabilities and there could be the risk of default as well, right? So this is what is the key points. Now here we need to understand as well the objective of working capital management. Like what is the objective? Okay, like why we need to manage. So generally why it's called working capital management, because once we will manage our receivables, cash, inventory, in the current assets and in the current liabilities, like if you will manage your payables, etc. So the management of these items is called actually working capital management. Okay, so now please remember, so when we manage our working capital, so there are certain objectives which we need to understand. Okay, so what is the objective of working capital management? So please remember, being a good finance person, so you always need to balance liquidity and solvency. Now these two terms are there. So what I'm saying, when you are managing your working capital, so you need to balance. You need to create the balance between liquidity. Liquidity means that you should have enough current assets to pay your current liabilities also, or you may have enough cash, let's assume, to settle your current liabilities, and solvency also. Okay. So what is here? Let's have a look here. So these 2 points. So what are these 2 points? Please remember here, we need to create the balance. Okay. So first of all, okay, I'm just assuming here. So the first thing which you need to understand while you are balancing the inventory and solvency, so you need to minimize the cost of liquidity. Okay, what is the cost of liquidity now? For example, if you will keep excessive cash, for example, excessive cash, maybe more than needed, let's assume. Okay, if you will keep excessive cash, it has cost for you. Okay, what is the cost to you? Because you are not investing this cash, right? You are keeping maybe with you, so you are not investing, so it will incur the opportunity cost for you because you are not investing. So now it means you are losing the opportunity to make the profit which you could have made through the investments, right? So this is what is the first point. So like they are saying that liquidity, first the word here explained liquidity itself. So what is liquidity? Okay, so liquidity involves holding assets like current assets, like cash or near cash equivalents that can be quickly converted to cash to pay current obligations. So in simple words, we can say liquidity means it's the ability of the business, okay, to pay its current liabilities as they fall due. So it means to pay or to settle the current liabilities, so you must have a liquid assets like cash or near cash equivalents. Okay, now here, however, maintaining a high liquidity. If you will maintain high liquidity, mean to say, as I gave you example, that if you will keep cash, excessive cash with you, so it you will incur the opportunity cost. And I have explained to you what is opportunity cost, because if you will keep higher cash, so cash or liquid asset typically earn lower returns, okay, compared to the investments in long-term assets or business growth opportunities. So what it means here, definitely, for example, I'm just giving example. Let's assume if you are keeping idle cash with you. So first cost is, if you are not investing. So first cost is, so you are losing the opportunity to earn return on this investment, okay? Because you are not investing, so you are losing the opportunity to earn profit. Another way, if you are investing, maybe if you are having cash equivalents, like those items which are nearly equal to cash, so like short-term investments, okay? If you have a short-term investments, so please remember, on short-term investments, generally return or profits are lower. But if you will invest maybe into long term, so their profits are higher. So this is also kind of sacrifice, right? You are sacrificing some profit by investing into short term. So this is what is the first point. Like if you will maintain high liquidity, so first cost you will incur, that is the opportunity cost, and second is idle resource. Idle resource means say excess liquidity can mean that resources are not being used effectively to generate profit because you are keeping idle. As I give you example, if you have a cash, so you are not investing, so it's idle, right? So you are not generating anything. Now here, guys, we also need to understand, we need to guard against insolvency also. Generally, what is insolvency? Technically, actually, guys, insolvency is like when your non-current liabilities, okay, are greater than, or simply when your total liabilities, we would say, or when your total liabilities are greater than your assets, so that is insolvency, because your assets are not enough to settle your liabilities. So here, so they're saying that insolvency arises when a business cannot meet its financial obligations, and definitely you will not be able to meet your liabilities if your assets are less, right? So as they come due, often due to insufficient cash flow or overburden of debt. So you may have an insolvency issue also. But here the point is, so what we have to do. So please remember, when you are managing working capital, so let me write in simple words. So what is our objective? Our objective is to maintain sufficient liquidity. Like in case if you need to settle your current liability, so you should have excessive cash also, but you have to take care of here the opportunity cost as well, right? Plus, you need to guard against insolvency risk also. Okay, so please remember, to avoid insolvency, companies must ensure that they should have adequate cash reserves or access to the short term financing. So please don't confuse yourself. So as I told you in simple words, so whenever you are trying to manage the working capital, so you have to just answer two question: do you have enough liquidity to settle your current liabilities? And you also need to answer another question: don't keep assets idle because you will incur the opportunity cost if you are not investing. So you need to create the balance. In short, this is what I'm trying to say. Okay, then here we have example here. So please remember, we have example here. For example, a retail company needs liquidity. Like if you are a retail business, for example, definitely you need liquidity to pay suppliers, wages, utilities, right? If it holds too much cash, for example, as I told you, first you should have some cash amount with you, some liquid asset with you to settle your liabilities. But if you will hold too much cash, it may miss the chance to expand its operation, right? So here you will incur the opportunity cost. If you will keep the cash idle with you, so you may miss the chance to expand your business. Conversely, if it uses all of its cash, in other way around, if you will use all your cash in your expansion, then there could be a problem. Maybe you would not be able to pay your current liabilities, right? And this is what they're saying: if it uses all its cash for expansion without keeping a liquidity buffer, then it risks insolvency if unexpected expenses arise. So this is what they're trying to say. So this is actually your example to understand the objective. Like, you should have, on one hand, you should have some liquidity to settle your liabilities. On the other hand, you should not keep your assets idle, right? Like cash idle, because you will incur the opportunity cost by not investing. So you need to create a balance in between. Okay, so this is what is the objective. And don't worry, what I said, so it will be, obviously we will practice through the questions, so you will get it very easily. Now here we are discussing here now working capital policies. Okay, so actually I'm going to talk about working capital funding policy. So guys, please remember, let me explain before moving to the policies. So we need to understand, when we say net working capital, it is equals what? Current assets minus current liabilities, right? This is what we say: net current assets minus current liabilities. And now please remember, if you will just focus here, we can further categorize these current assets into two categories. So first category is called permanent working capital, okay? And second is called temporary working capital. So what is the permanent and temporary working capital? So let me give you example. For example, you are running a store. Let's assume you are into the retail business, and on average, this is your routine of your business. Always you keep cash of 100,000, always. Okay, let's assume. And always you have minimum receivables of, let's assume, 300,000, just assuming. Okay, always you have minimum inventory of, for example, 200,000. I'm just giving you example. Okay, so this is what in routine you always have. So these are called now permanent, because permanently these are kind of long term. Like for example, cash you always hold 100,000, receivables you have 300,000, inventory you have 2 million or 200,000, whatever amount you can assume. So these are called permanent working capital. Okay, and then what is fluctuating? For example, if you have season, let's assume you are running ice cream business. Let's assume in season maybe your cash balance may go up. Okay, your receivables may go up, or whatever business you can assume. Okay, or maybe your inventory can go up, right? But out of season, maybe you need less cash, less, maybe your receivable will be lower or your inventory will be lower. It means some portion of these assets, current assets or working capital, you can say, they fluctuate with maybe seasons, right? So those are called temporary working capital. Okay, so it means we got a permanent working capital. So here it is defined: a permanent working capital is the minimum level of current assets maintained by a firm. As I gave you example here, that maybe you are maintaining cash of 100,000, receivables of 300,000, and inventory of 200,000. Then the permanent working capital should increase as firm grows. It is true, because if your business is growing, definitely you need more cash, more receivables, more inventory. So, and if you are the other way around, you can say, if your business obviously is under maybe depression, or recession. So definitely maybe you need less. So they're saying permanent working capital should increase as the firm grows. Then the permanent working capital generally is financed with long-term debt. So this is, I'll actually tell you funding policy later. Don't worry. So I'll explain this later, this point later, because I'll explain through the policies. So far I have explained what is permanent working capital, temporary working capital, and what is working capital and net working capital. So here we go. And this is here it is defined temporary working capital, which fluctuates seasonally. Okay. So I hope so it is clear. Now, guys, just a few minutes, then we'll practice the questions from these basic ideas. So here we got now working capital policies. Okay, now we got here a working capital policy. So guys, we got actually three working capital policies. First policy is called a conservative approach. Second is called aggressive approach. Okay. And third, you can call it moderate approach. Okay. So here we go. What is conservative approach? So please remember here. So here few points I want to explain actually, and those points you need to keep in your mind because these points they test in your exam or in the questions. So here we go. For example, what is conservative? Okay, please remember here. Conservative, it's one of the school of one is one of the school of thoughts actually. Conservative approach. So these are those people they don't want to take risk actually. Okay, these are conservative people. So what they will do? So first thing, under the conservative approach, so they will maintain higher working capital, okay, or higher current assets. The first thing, because they don't want to take a risk. They don't want to take a risk, of delaying the payments. They don't want to take the risk of stock out. Okay, so they are conservative. So what they will do? So they will try to maintain higher level of current assets. Okay. Second point you should remember here. Second point. So definitely if current assets are higher, so ratios related to working capital like current ratio and quick ratio, which is also called asset test ratio. So their answer will also be higher. Okay. Second point you should remember. And then the third point you need to remember here. Okay. The third point is what? So they are taking less risk. So they are taking they are minimizing their liquidity risk. Okay. Minimizing the risk. Okay, how they are minimizing by holding higher current assets, right? So then this is now if you will remember here, and the next point you should remember it, the conservative people. So if they need funds to finance their working capital, so what they will do, they will use long-term sources of finance. Long-term sources of finance to finance these current assets. Okay, so long-term, like maybe they may take the funds from issuance of equity or maybe long-term debt, right? So they are using long-term sources of finance to finance the majority of working capital. Okay, so the majority of working capital means say like it includes permanent and fluctuating. So for the majority of working capital, they will use long-term sources of finance. So here we go. These were the points I have written here now, and now I'll go through from here what is written here. Okay, so this is actually the summary which I have written on the screen. So here we go now. The firm that adopts conservative working capital policy seeks to minimize liquidity risk. So this I have written here, right? So they will take less risk by increasing working capital because they will invest more into current assets. Okay, then so the firm seeks to ensure that because these people or these firms seeks to ensure that adequate cash, inventory, and supplies are available and payables are minimized, right? So they will try to ensure that they are having high level of cash, inventory, and receivables. Okay. So the firm forgoes. So this is look this point. The firm forgoes the potentially higher returns from investing in long-term investment. Actually, this is what is the opportunity cost they incur, because they invest into they invest more into current assets, right? And definitely if they are investing in current assets, so generally on current asset returns are lower, so they don't invest into long term. So this is what they're saying: the firm forgoes the potentially higher returns from investing in long term assets and instead keeps the additional working capital available, so they keep extra things. Okay, then what? This policy is reflected in higher current ratio, which is current ratio we studied, which is equals current asset divided by current liabilities, and higher asset test ratio, which is also called quick ratio, so which is equal to quick assets divided by current liabilities, right? So this we have already, these ratios we have covered, and this is this point. So current ratio and quick ratio will be higher. Then what is next? So now this point, long-term source of finance, this is what I have told you. So now they will actually more rely on long-term sources of finance. So the policy heavily relies on long-term sources to finance not only fixed asset but also significant portion of current asset, because our concern is here current assets, right? So as I told you, the majority of the current asset will be financed by using the long-term source of finance. Okay, now examples for the long-term source of finance could be financing through equity or by using the long-term debt. Okay, so what's the rationale here? For using long-term source of finance, the rationale is that so the long-term financing is more stable. For example, if you are taking money through the long-term loan, so you know in advance when to pay installment and how much you have to pay, right? So that's why it is more stable and predictable, and this reduces the risk of liquidity crisis. Okay, how liquidity crisis? Because for example, if you will take loan from short term, assume, and you will invest into inventory, maybe if inventory is not sold and now there is a time to repay the short term loan, so you would be in definitely in problem, right? So they don't want to take this risk actually. So this is what is the rationale. So that's why they use long term source of finance. Okay, now I'm going to explain the aggressive. First I told you conservative working capital policy, and now we are talking about here aggressive working capital policy. It's another policy now. It's totally mirror image of the conservative. So please remember, in conservative, what we discussed, now we will discuss in opposite way under aggressive. Under aggressive approach, can you just go back here? We'll see. So here, the current assets will be under conservative, current assets were higher. Now here, investment in current asset will be lower. Second point, so here I told you uh, there will be higher current ratio and quick ratio, higher answer for these ratios, but now the answer will be lower for the current ratio and quick ratio because you are maintaining lower current assets. And the next point is, so you are minimizing the risk of liquidity. Here you are taking the risk of liquidity because taking the risk. Okay, you are taking the risk of liquidity. The reason your current assets are very lower. So assume if you have some short term liabilities to pay and you don't have enough current assets, definitely you are facing issues, right? So this is what they are saying, that so they are taking the liquidity risk. Okay, and so they, on the other hand, in the conservative we were using long term source of finance to finance the working capital. Here we will use short term sources of finance. Okay, now let's have a look what the your book says. So here we go. A firm that adopts an aggressive working capital policy seeks to increase the profitability while accepting reduced liquidities. Actually, here you can add here. So they are taking risk. Okay, okay, and they are looking for high profit. And definitely high profit you can get how? So if you will keep less current assets and you should invest this money into other investment options, right, where you can get higher returns. That's why they are seeking to increase the profit and minimizing the liquidity risk. They're seeking for it. Okay, so this is what they're saying. And they're taking high risk of short-term cash flows problems. So this I have already told you. So they are taking more risk. Okay, then this policy is reflected in lower current ratio and quick ratio. This is this point. Then carrying excessive current asset, as per them, they're saying if you will carry excessive current asset such as inventory, it increases cost, right? So that is why your profit will be compromised. So like for example, if you're keeping excessive inventory, so you need place to store, right? Like warehouse, you will pay rent for that, utilities for that. So it will increase your cost and definitely it is going to decrease your profit. So this is what they're trying to say. So if you want to increase the profit, so you need to keep these costs lower. Okay, then I told you a short-term financing. As I told you, under aggressive approach, we will rely more on short-term financing, and we can say this way that majority of the current assets, which includes permanent and temporary, like majority of that will finance through short-term sources. Okay, so the policy emphasize the use of short-term sources. They're saying that we should use short term to finance both current assets and portion of fixed assets. Now, what is the rationale here? Because our focus is mainly on current assets. So they're saying what's the rationale for this? Why they are saying we should use short term, not the long term? So they're saying short term financing typically has lower interest rates. Like if you will take short-term loans, so interest rate could be lower because bank is taking less risk. They are giving you loan for the short period. But on the other hand, if you are taking loan for the longer period, it means bank is also taking risk. So he will charge higher interest, compensate his risk, right? So this is what they're saying. Short-term financing typically has lower interest rates compared to the long-term financing. But what's the problem with the short term? But comes with high risk due to frequent renewals and fluctuations in interest rate. Right? For example, as I give you example, if you will take a short-term loan, okay, for example, 100,000, and you invested in inventory. Now, for example, what if this inventory is not sold? So what will happen? So definitely you will be in a problem because short-term loans you have to settle in the short period of time, right? Sometimes you need to settle the whole short-term loan to get renewal again. Okay, so this is what they are saying. So this is the risk as well. But the main point is they are using short-term sources. Okay. Now, guys, uh, third thing, here we got a small note which you should also remember. Please remember, generally, when we say, okay, then what should be the investment in current asset? Should we have higher or should we have lower? Actually, it depends upon the industry in which you are operating, right? So, for example, if your neighbor business is selling goods on credit, so you also would sell on credit, right? Because if you would not sell on credit, maybe you will lose the customer. So that's why sometimes we need to follow the industry norms as well. Okay, there is a third approach which is not written here, but I can just explain. So that is called moderate approach. Sometimes in some books it's written as moderate approach. Okay, and in some books it's written as maturity matching approach. Okay, so idea is very simple. They are saying that you should know, for example, in the company, if you will look into the company's assets, so we got non-current assets which are long-term in nature. We got current assets. Under current assets we have two types: permanent and temporary, right? Permanent and temporary. So please remember, permanent is also long term in nature, temporary is short term in nature. So what maturity matching or moderate approach, what it says that so you should use long term sources of finance for the long term assets like non-current assets and permanent current assets, and you should use short term sources of finance for temporary current assets, right? The reason, you are trying to match maturity of the asset with the duration of the loan or duration of the finance, right? So non-current assets, they are long-term in nature, use long-term financing. Permanent current assets, they are also long-term in nature, use long-term financing. But temporary, because they are short-term in nature, so use short-term financing. So like try to match the maturity of the assets with the duration of the loan. This is what is moderate approach or maturity matching approach, right? Okay, so that's great. So now we are going to practice some questions here. So here we go. You can just get the idea how question would be tested here. So we got a question on your screen. So they are saying that a company is experiencing a sharp increase in sales activity. Their sale is increasing and steady increase in production. So production is also increasing. So management has adopted aggressive working capital policy. Okay. So you should not forget aggressive. Okay. In aggressive, what will happen? Current assets will be lower. They are taking risk higher, right? Right. They are taking high risk. Okay. To get high profit, profitability will also be higher. If you remember, this is what these points I'm saying that. Okay, here. Current assets will be lower under aggressive. Current ratio, quick ratio will also be lower. They're taking high risks to increase the profit. They are relying on short-term source of finance. Okay. So if you will now look into the question, so this company is following this policy. So they're saying that therefore the company's current level of net working capital, like if you're following aggressive working capital policy, so definitely your current assets are going to be lower, right? This is what they're saying. Therefore, the company's current level of net working capital should be lower. Net working capital should also be lower because current assets minus current liability. So here, so if current assets are lower, definitely your net working capital will also be lower, right? So here, if you look into the option, look at the first option B. They're saying the net working capital would be higher. No, it's incorrect. Again, that's option C, net working capital would be higher. It's incorrect. Then they're saying that a net working capital would most likely to be same as in other type of business condition. No, it is not going to be same. It is going to be lower. Now, if you look into the first option, so the net working capital would most likely to be lower. Yes, this is correct. Then other business conditions in order that the companies can maximize profit. Yes, we are looking for high profit while minimizing working capital investment because we keep less investment in current assets. So this is the answer of the question. Okay. I hope so it is clear. Then we got another question on your screen. They are saying which one of the following would increase the net working capital of the firm? Okay, so net working capital equals current assets minus current liabilities. So now which will increase the working capital? Definitely only one condition. If current assets are increasing, then working capital will increase, right? Or if your current liabilities are decreasing, working capital will increase. This is one condition, right? But other I'll explain through the questions. Okay. There could be a couple of conditions, but generally this is the general situation that if current assets are higher than previous period, so your working capital will increase, or if your current liabilities are lower than previous period, your working capital will decrease. So which one of the following would increase net working capital? So here we go. First, a purchase of new plant. Plant is non-current assets, and here we consider current assets. Okay, and this is financed by 20 years mortgage. Okay, it is your non-current liability. So it means both changes are in non-current assets and non-current liabilities. Nothing is changing in current assets and current liabilities. So this is irrelevant point, right? So this could not be the reason. This is not the reason. Okay, this would not be the reason to increase the net working capital. So this is not the option. Then cash payment of payroll taxes. Okay, what happened? So cash payment means say it's a reduction in current asset, and you have paid payroll taxes. That's your current liabilities. Current liabilities also has reduced. Both has reduced with the same amount. So net working capital will be unaffected. It is not the reason to increase the working capital. Question is about to increase the working capital. Okay, so it's not the reason. Then look at the D, cash collection of account receivable. So what will happen? If you will collect the cash, one time your current asset will increase because you are collecting cash, and on the other time your current asset will decrease with the same amount because your receivable is decreasing, right? Because you collected cash from receivables. It means your current assets overall unaffected. Again unaffected because cash has increased with the same amount receivable has decreased. It means overall current assets are unaffected. So that is why it is not going to be the reason. Okay. Uh, to increase the working capital. So this is not the option also. Now it means only one option is pending. So that is actually the answer of the question. They are saying refinancing a shorter note payable with 2 years note payable. I'm not sure if you have idea about refinancing. Okay, so let me explain here. Short-term note means say it is your current liabilities, and long-term note means it is your non-current liability. In the question he told you, okay, non-current liabilities. Now what? Refinancing means say what? For example, I have taken a loan from a bank and now it is due in 3 months only. It means it's my short-term liability. Now what I have done? So I have contacted other bank. Okay, I took the other loan, or maybe I have agreed with the other bank to take the loan for 5 years. Okay, now and I'll use this loan to repay this liability. So this is now called, this concept is called refinancing. It means what is going to happen? Okay, so this liability will be removed from the current liabilities. Okay, because we have agreed with the bank, so he will provide me the amount. So I'll use the non-current amount to settle this current liabilities, right? Even I will use maybe in 2 3 months. So now this current liability will be removed, only non-current liability will stand. So if current liability will be removed, it means your current asset minus current liability. It means your current liabilities are going to be lower. So due to that, okay, due to that, so your net working capital will increase. Yes, this is the option actually. Okay. So actually with this concept we discussed in part one also, refinancing of current liabilities in more detail. Here I just gave you a shortcut. Okay. So we got another question now on your screen. Now we got guys another question. They're saying that all of the following statements in regard to the working capital are true except, like, what is simply the question is, which statement is incorrect regarding working capital. This is what you have to identify, and that is the answer of the question. So here they are saying that first, the hedging approach. Hedging approach means a moderate approach, maturity matching approach. That is also hedging approach. To financing involves matching maturities of the debt with the specific financing needs. Yes, I told you, like, maturity of assets, we match with the duration of the loan. This is correct. So then they're saying financing permanent inventory build with long-term debt is an example of an aggressive working capital. No, in aggressive we use short-term. So majority of the assets we use short-term source of finance. It's incorrect. Okay, actually this is the answer of the question. Understood? So this is the answer of the question. Then current liabilities are an important source of financing for many small business. Yes, like if you buy goods on credits or trade payables, definitely it's a major source for many businesses. Then profitability varies inversely with the liquidity. Yes, if you will keep high liquidity, your profitability will be lower because you are not investing, right? If you will keep less liquidity, so your profitability will increase because you will invest. Okay, or you are investing. So this is actually the B is the answer of the question. I hope so it is clear. So this statement is also correct. This statement is also correct. First is also correct, but the question was which statement is not correct, so that is B. Okay guys, this is our question will be tested. Now I'm just moving to the other, because other question you can just practice at home. So now let's have a look at the topic. So that is cash management. Okay, so cash management we are discussing now. So because cash is one of the major component of your current assets, so the importance, the management, obviously the management of cash is really important for the business. So here, but we'll start first with here. So why the businesses they hold cash? Why? Okay, we hold cash. Okay, so the question is motives for holding cash. So they can ask, okay, in the MCQs also, in essay questions also, like, why do we hold cash? That's the question. So you have to think from business point of view. Even you can think from your individual point of view also. For example, I'm earning salary. Let's assume $100. Let's assume, and what I'm doing, I'm segregating my salary into three portions. Number one, for my day-to-day expenses, for example, for grocery, electricity bills, etc., rent. Okay, and let's assume I kept $20 for that. So this is actually called transactional motive, and for day-to-day transaction. Okay, then maybe I'm saving 30 dirham or $30 every month. Okay, just for uncertainties, maybe in emergency I need to travel to my home country, or there could be any medical issue, anything. Okay, so that is called precautionary motive, because I'm reserving cash for contingencies. Okay, and let's assume remaining $50 I'm keeping every month separate. Maybe I want to invest. Okay, to make money, right? So maybe I want to grab some investment opportunity. So this is actually called speculative motive. So same story you can apply on the companies as well, because whenever whatever the cash reserves they have, they always divide cash into three categories for the following motives. First is transactional motives, because they want, the companies need cash. Obviously they need cash to pay rent, salaries, wages, okay, insurance, etc. So maybe for the purchase of inventory, etc. So that is transactional motive. And they also keep some cash for precautionary, to provide reserves for contingencies. For example, maybe what if your assets would damage through the fire, so definitely you need to replace, so you should have some reserve. So this is for some emergencies, okay. So some cash definitely they keep for speculative, means say investment, for investment purpose, to take the advantage of unexpected opportunities, like investment opportunities, okay. So these are three motives of cash holding. I don't think so it is tough. So now here again, the question is, what should be the optimal level of cash? Like how much cash we should keep with the company? Okay. So again, you need to know the cost and benefit analysis. Okay. Cost and benefit means, say again, if you will keep excessive cash, you will incur opportunity cost by not investing. Okay, because you are losing the opportunity to make profit. But if you will keep lower cash, maybe you will be stuck in settling your liabilities or day-to-day transactions. So that is why we need to do the cost and benefit analysis. Okay. Because cash does not, if you have hard cash with you, does not earn a return, right? If you are keeping with you only, so only the amount needed to satisfy current obligation as they come due should be kept, as I told you. So this is what is general, we need to create the balance. Okay. And now here we got some one more point, like because when we talk about cash management, so first we need to think how we can speeding up cash collections, how we can, you know, quickly, how quickly we can recover the cash. So or how we can speed up, okay, the collections. So guys, there are so many different ways, but here first I'm going to start with something different. Okay. So first I'm going to explain here the float period. Okay. Okay. Float period from cash receipt point of view. From cash receipt point of view. Okay. What is float period here? Okay. Generally look at here. So it's very simple. I'll start with the example. For example, I'm running a business. Okay. So today I got a check from the customer. Okay. From customer. Now what happened? From customer, I got the check. Okay. What happened? I kept it into my, let's assume, drawer. Okay, and I forgot 5 days. I forgot 5 days. It was in the drawer for 5 days. After 5 days, I remembered, oh, there was a check. So immediately I went to the bank. I deposited that check, and maybe bank took 2 days to clear it. So total, how many days I spent? Maybe 7 days, right? So actually, this is the 7 days is now float period. So you know what? How we define the float period? Actually, this is how it is defined. It is the period from when a payer means a customer, mails a check until the funds are available in the pay's bank account is a float. Okay, that one we receive the check from that point. So once we will get the payment into our account up to that point. So whatever the time we are taking, that is the float period. Okay, from receipt point of view. So they're saying that this float period, to speed up the cash collection, we should reduce the float period. It is good for you. Okay. You should reduce it because as you will receive the check immediately, you should deposit, and within 1 2 days you should get the amount in your bank account, right? So this is what you need to manage here. So now the question is that here, next question is, they're saying that the firm uses various strategies, because here some calculations I'll do, and these calculations could be tested in your exam. Okay. So they're saying firms use various strategies to decrease the float time for receipt. Like how? Number one strategy I'll discuss, here we go. They're saying the product of the daily amount of receipt and the number of days of reduced float is the increase in your average cash balance. What they're trying to say, for example, if your daily cash receipt is $100, let's assume, and if you are successful in reducing your float period by 2 days, so reduction in float period is, let's assume, 2 days. It means, so you saved the cash of how much? $200, right? In total. And these $200 now you can invest somewhere and you can earn return on that. So it means, so we need daily cash collection multiply by reduction in the float period. So this will give you increase in cash balance, and this increase in cash balance you can invest and you can earn return on that. So that return could be given with the name of opportunity cost, with the name of rate of returns, whatever. So is given, for example, it is 10%. So let's assume $200 into 10%. This 10% is per annum rate. Okay. So it means at least $20 you can earn as a return or due to this reduction in the float period, and this is going to be your benefit. Okay. So this is what they're trying to say in this sentence. So annual benefit, how would you calculate? Daily cash receipts times days of reduced float. This will give you increase in cash balance overall times opportunity cost of funds, like this investment rate. So this will give you benefit. What it will give you? Benefit. So this is how you will calculate the benefit, annual benefit. Okay. Now here we have example for that. So here we go. So they're saying that, for example, a firm has $22,000 in daily cash receipts. Okay, it's a daily collection average. 22,000 you are receiving. It is considering, it is considering a plan that cost $0. Okay. What's the cost of the plan? Zero. They're saying and speed up collections by 2 days. Okay, it means what would be your increase in a cash balance if you will speed up your collection by 2 days and your daily cash receipt is 22,000. So it means daily cash receipt is 22,000. A days of reduced float is 2 days. So this will give you increase in cash balance, which is 44,000. This 44,000 you will multiply with the opportunity cost. For example, opportunity cost is what? So they're saying marketable securities where you can invest this 44,000 currently pays 6% annually. So you will multiply with the 6%. This is going to give you benefit 2640. Okay. So please don't forget the formula. Formula is daily cash receipts times days of reduced period. This will give you increase in cash balance. Multiply with the opportunity cost of funds. This will give you benefit value. Okay. Because you need not to calculate only benefit. So you should calculate the cost also, right? Because sometime there are different ways to speed up. So that I'll show you just in a few moment, a few maybe minutes. Okay. So we need to know what is the cost of arrangement. Okay, which we are using to speed up the collection. So that cost you will compare the cost of arrangement. You will compare with this benefit which you have just calculated here, and then see benefit is more or cost is more. If benefit is more, go for the reduction in the float period. If cost is more, then don't go. Okay, this is your decision. So here we go. I'll add that information, don't worry. So they're saying that the benefit of any plan to speed up cash collection must exceed the cost. So benefit should be greater than the cost. Okay. Now we got a question here. They're saying annual benefit is again we got an extended example here. So here we go. We got a complete question. This is how the question would be tested in your exam. Okay. They're saying a firm has daily cash receipts of 150,000. Great. A bank has offered to reduce the collection by 2 days. Okay. So we can calculate first the benefit, which is equals daily cash receipts, daily receipts into reduced float period into opportunity cost. So we got a daily cash receipts of 150,000 times float period is reduced by 2 days times we have to find opportunity cost. And then they're saying that uh, increasing the firm's average cash balance. Yes. Okay. By 300,000, we got 300,000. If you will multiply these two, okay, the bank will charge. This is actually cost information. The bank will charge cost monthly fee of 1250. This is the monthly fee, monthly. Okay. The money market funds are expected to average 8% during the year. Okay. This is actually opportunity cost 8%. If you will just multiply quickly, let's have a look. What's your benefit value? So we got it here 150,000 times 2, which is 300,000 times 8%. So it is going to be, your benefit is going to be 24,000. Now you should calculate the cost. Cost is what? So bank is charging monthly fee of 1250. So 1250 is monthly fee. For 1 year, it would be multiplied with 12. So the monthly fee is going to be 1250 times 12. It is going to be 1,500. This is your cost. Now see, benefit is 24,000. Cost is 15,000. This is 15,000. Okay. Okay. So cost is 15,000. Now, guys, please remember here, if you will multiply, if you will just compare 24,000 with this 15,000, so your benefit is more. So it means you should go for what? For the reduction of float period. Okay. You should agree with the bank. Now, guys, we got it here, lockbox system to speed up cash collection. This is actually the one approach to speed up the cash collection. So what is lockbox systems? How it works? Okay. So guys, please remember here. Actually, for example, you are a company. So now previously what you were doing, you were asking the customers to send checks to your business premises, right? Maybe then from there, you were taking more time to deposit into banks and it was delaying your cash receipts. So now to fix this problem, you can go for lockbox system. Okay. So what is the lockbox system? So what it is, this is how it will work. So now here, lockbox system, it's a the company is going to have a designated PO box like post office box. Okay. Now maybe on the different locations. Okay. Now what? Instead of sending checks to your company, now the customer will mail the check to this box. Okay. They will send their checks to this PO box. And now what? So the bank people, because you are going to agree with the bank, so bank people, they will come frequently, maybe multiple times in a day. So they are going to check this box, and if there are any checks and related documents, so they will take these checks and immediately they will deposit into the bank. Okay. And this is how you can manage or speed up cash collection. So this is what is explained here. Number one, customer payment sent to the logbox address. Customer payments sent to the logbox address. Here they're saying a business provide its customer with special cost of post office. A business provide its customer with special post office box, which is lockbox, instead of its regular address for mailing payment. So you will have designated PO box, maybe in different locations. So this lockbox is managed by the company's bank. Okay, how they will manage? Bank collects payment. How? The bank retrieves the payments, means the checks and remittance documents from the logbox multiple times a day. Now, definitely this service which is offered by the bank, it is not going to be a free of cost, right? So the bank processes the payments on behalf of the company. And this includes what? Opening the mail. They will open the mails, means envelope, recording the payments details, and depositing the funds into the company account. And how the company would know that bank has collected these payments? Definitely, so the bank will report to the business also, and the reporting could be automated also, because bank can link their system with the company system. Okay. Or maybe the bank manually, they can also send the reports of the transaction. Okay, like scanned images, etc., to the bank, to the company, right? And please, again, in exam question, they may ask you, should we go for lockbox system or not? So you will again calculate the benefit similar way. You will calculate like what is your daily receipts, you will multiply with the reduced float period, and you will multiply with the opportunity cost, similar way as we just did before. And this is your benefit. From there you will deduct cost, and the cost will be what? The bank fee. Okay, whatever the bank fee is there. So if benefits are greater than cost, then you should go for the lockbox system. If cost is greater than benefit, then you should not go for it. Okay, so this is what is lockbox system. Okay, guys, so just give me a 2 second, please. 2 minutes actually. Okay, guys, so now here we got another approach which is called what? Concentrated concentration banking. So this is another approach to speed up the cash collection. Okay, first I told you lockbox system, so that you can use lockbox. Okay, so second is concentration banking. So please remember how it will work. For example, if your business is in different region A, region B, okay, region C, region D. So please remember, here the company, what he will do, he will open the local account also. Okay, the bank account in the at local, at regional level. For example, one you have a local account here, one you have local account here, one you have a local account here, one you have a local account here. And customer, what they will do, customer will, let's assume if customer is living in region A, he will deposit the cash into this account. If customer is living in region B, he will deposit the cash into this account. And if customer is living in region C, he will deposit into this account, and so on. Okay, and what bank will do at the end of the day, at the end of the day, whatever the cash receipts they have, at the end of the day, whatever the cash receipts they have, so all these cash receipts they will deposit into main principal bank account. So they will have one main principal bank account also. So all collection which they have collected in the local accounts, so they will send it to the, maybe through online, they will send it to the main principal account. Okay, this is called concentration banking, and this account is called concentrated account. Okay, concentrated, the main account. So here we go. This is the stories explained here. Number one, a company set up a local or regional bank account in different geographic area where it does business. These accounts are closer to the customers, reducing the time it takes for payment to reach a bank. Okay, so first we will have a local accounts. Customer make payments locally. Customer sends their payments to the nearest collection account instead of a central location. We don't send to the main, just they will go to local accounts. Okay, they will deposit cash there. Then periodic transfer to the central account. Central account means say this main account. So funds from these local accounts are regularly transferred to the central account, often at the company's headquarters or the main bank. Okay, the transfer are made using automated clearing house, or it could be a wire transfer. Okay, you know, the online transfer. And here definitely these kind of they're saying centralized cash management, because from the local accounts cash will go to one's main principal account, right? So it will, then they're saying once the funds are concentrated in the central account, means in the main account, so the company use them for operating expenses, invest surplus cash, or pay off loans or other obligations. Okay, so we got example here. Imagine a retail chain with stores in different cities. Let's say we have a retail business. Each store deposit daily sales. This is another practical example. Okay, each store deposits daily sales into a local bank account. The funds from all these local accounts are transferred to the company's main bank account at the end of each day. Right? This is practical. This ensures that all cash is pooled centrally, making it easier to manage and use efficiently. Right? So these are generally two methods which we can use, okay, like concentration banking or lockbox system to speed up the cash collection. Now we are discussing about slowing cash payments. So slowing cash, first I want to tell you now payment float period. Previously I told you float period for receipt, right? Now I'm talking about payment float period. So now let's you are a customer. You have to pay to the supplier. So what you will do, if for example today you wrote the check, today for example you wrote the check, maybe 3 4 days it will take to go to your supplier, maybe 2 days he will take to deposit and get the amount into his bank accounts. It means float period is 5 days. Actually this is payment float period. This is also called disbursement float. Okay, so they are saying that disbursement float is the period from when the payer writes a check. Payer means obviously you will be the payer here. Okay, writes the check until the funds are clear and are deducted from your account. Okay, so check float results in interest free loan, because why, you know, it takes 5 days, right? So it takes 5 days, uh, when you wrote the, when you write the check and when it is deducted from your account. For example, if it takes 5 days, it means for these 5 days, so being a account holder, you have access to this cash for 5 days, right? You can use for 5 days. So but sometime what will happen, if you will use it, maybe the amount will be insufficient in your bank account, and once your supplier will present that check, right? So the check might be bounced, right? So this is then the problem. To avoid this risk, okay, to avoid this risk, okay, maybe the check might be bounced by the bank due to insufficient funds, so companies can go for overdraft protection also. What is overdraft, you know, we can agree with the bank a limit which is also called line of credit. Okay, so in case if the for example in my account amount is $100, and I have agreed $200 as a bank overdraft limit. My in my account is I have only $100. So what I'll do now, let's say I wrote the check for 150. Once this check will go to the bank, definitely we have insufficient funds. So what bank will do? Bank will take $50 from the overdraft, $100 this, 100 plus 50, 150. They will cash this check, right? They will clear this check, but bank will definitely charge the fee for this $50 because this facility is provided by the bank, right? This is what is overdraft protection. Now we got here some other zero balancing accounts. This is another approach now. First approach, I told you what, not first approach. First, I told you just disbursement float, and now we have other methods for managing cash outflows. Outflows. Other method is what? Zero balance account. Here, let's assume you got a two accounts, two bank accounts. This is account one. This is account two. So this account is designated for zero balance. Zero balance means say what? Uh, just it's like that. For example, if I want to make a payment, so what I'll do, uh, actually I'll write the check for this account, okay, for this account if I want to make payment. And what bank will do, he will take the money from this account, will transfer here and clear the check. Okay, so this is zero, and then again this account will become zero. Again, next time whenever check will be issued, amount will be transferred from the main bank account to this. Okay, and this account will be used for payments, and again it will become zero. For example, I want to transfer salaries, so the bank will take the money from the main bank account, required amount, into this bank account, and from here they will disperse the salary. Again it will become zero. This is called zero balance account. So they're saying zero balanced account, which are checking account in which a balance of $0 is maintained by automatically transferring funds from master account in the amount only large enough to cover checks presented for payment. Okay, so this bank is actually managing. If you have any unused amount in this amount, they will transfer back also. Okay, and whenever they need money to this account, they will transfer from here to this account. Okay, then we got a guy's compensating balance. They're saying a compensating balance is the minimum amount of that bank. What is compensating? For example, you opened a bank. I have already explained by the way in previous lectures. For example, you opened a bank account. Bank is asking you that you have to maintain, for example, $3,000 minimum or $300 minimum into your bank account. Okay, you have to maintain $300. So this is called compensating balance. And if your balance in the bank account will be lower than this, bank will charge for that, right? This is compensating balance. So compensating balance is the minimum amount of that bank requires a firm to keep frozen in its account. Why the bank wants this minimum amount? Because sometimes uh, bank they want to deduct charges, and what if you don't have a account? So bank will wait. Okay, when what if you don't have amount in the account? So bank will wait. Okay, so that's why they ensure that you should have sufficient funds in your account so the bank can deduct their charges. Okay, for example, charges for unlimited checks writing, etc. Okay, so they can deduct. So that's why they ensure that you should have some compensating balance there. So they saying compensating balance are non-interest bearing, because whatever money you are keeping there, you will not get interest on that as a account holder, and are meant to compensate the bank for various services rendered such as unlimited check writing. So these balances incur opportunity cost because they are unavailable for investment purpose, right? Opportunity cost is there for this amount. The reason you cannot invest anywhere. Okay, guys, I hope so it is clear. So please, I would request you to perform the practice question now.